Welcome to Illuminati Silver. We tell you the truth about silver. Today is Monday the 30th of September 2019. And earlier today we published a podcast video entitled, How Low Can Interest Rates Go? We've put a link in the description box below. Now this video is an addition to that one, pointing out that not only will we have lower interest rates in the months ahead, but also quite possibly more cash printing, especially if the advocates of MMT, modern monetary theory, have their way. This video asks the question, does or can MMT work? Who is most likely to introduce it, and why, ironically, central banks have so far protected us from it, in spite of what the pumpers may tell you. So let's investigate. One of the greatest problems bankers have is, quite frankly, people believing them. There are many reasons for this, and the skullduggery in LIBOR commodities and even bank account opening manipulations have justifiably earned public disrespect. However, that said, there is a very strong argument to suggest that the existence of an independent central bank has, at least so far, saved the West from hyperinflation, which, if the politically left-wing gain power, or advocates of MMT gain the upper hand, this will be potentially all but over. One of the most respected journals in the UK banking fraternity is the London Institute of Banking and Finance Financial World magazine. In this month's edition, Jamie Danhauser, an in-house economist at Rufer, an investment management company, takes a critical look at modern monetary theory and explains how it broadly works and what are the pitfalls. It's quite a long article, so it is read rather quickly. It is also slightly technical, but broadly is self-explanatory. So we shall read the article and then comment on it. The Magic Money Tree. Jamie Danhauser takes a critical look at modern monetary theory, which he says has become linked to the broader political agenda of the populist left. Quote, the macroeconomic policy toolkit has expanded significantly since the great financial crisis. Central bankers now do far more than just set their policy interest rate, and they also deploy their expanded powers for far longer than seemed likely when the crisis struck. But the principles that guide how the state should manage the business cycle and for what purpose have not changed. Price stability, codified in inflation targeting, remains the preeminent focus, and monetary policy is the primary instrument for controlling aggregate demand. Given the scale of the crisis-induced recession in 2008 to 2009 and the populist outrage it spawned, this is remarkable because, while flawed analysis and policy errors by central bankers were not the dominant causes of the implosion of the financial system, policymakers do have a case to answer. The fiercest criticism of the status quo in macroeconomic theory has come from the advocates of modern monetary theory, or MMT. Its proponents are a small group of heterodox economists, largely from the United States and mostly in the post-Keynesian tradition. It is neither as revolutionary nor as modern as its proponents suggest. Nevertheless, it does have critical insights about the nature of money and the workings of our modern financial system that conventional approaches downplay and in some cases disregard entirely. Now, some of its policy prescriptions, in particular those about how best to manage the business cycle, have merit. But MMT is more than just an unorthodox economic theory. It has also become intimately linked to a broader political agenda, in particular politics that are hostile to the financial sector and big business, critical of policymakers' response to the crisis, and supportive of aggressive government action to tackle inequality, curb corporate power, and manage climate change. MMT has morphed into a policy platform of the populist left. But what does it say, and how might it be useful in economic policy? Simplifying somewhat, the theory makes 4 central claims. First, money is a creature of the state. The state demands that we meet our tax liabilities by transferring a given amount of bank deposits to a government account. Equally important is the fact that settlement of financial transactions between commercial banks is conducted in central bank money. The monetary system that households, companies, and investors rely on cannot function without banks' ready access to an interbank system, underpinned solely by central bank reserves. And the state is the monopoly issuer of these reserves. Backed by the state, banks are therefore unique financial entities because their liabilities are the medium of exchange. Moreover, they can create these liabilities, money, out of nothing, instantaneously adding to the purchasing power available to households and companies. They do this by granting loans, a process that involves nothing more than the addition of equal and offsetting entries to the electronic ledger recorded by the bank. Second, lending creates deposits. This is counterintuitive to many. Indeed, conventional macroeconomic models suggest the opposite. Banks are said to be intermediaries that transfer existing savings, loanable funds, to those that want to borrow. But sensible as this sounds, it's not how banks actually behave. More importantly, this innocuous assumption turns out to be anything but. This brings us to the third element of the MMT case. Conventional wisdom asserts that fiscal policy is too clunky to manage the economy effectively. Moreover, governments face binding budget constraints. Proponents of MMT challenge these assertions, and there is evidence on their side. A wealth of empirical analysis finds that fiscal policy is an effective tool at managing demand, and is essentially powerful when the economy is weak. The more controversial point is that the debt financing of any gap between government outlays and receipts is nothing more than a political and institutional convention. Conventional wisdom argues that the fiscal authority must raise those funds from elsewhere, either by coercing its citizens via taxation or incentivizing them via the issuance of bonds. MMT proponents look at things differently. They counter that the state owns the bank that underpins the entire monetary system. Now, this is not always true. For example, the Federal Reserve is ultimately owned and funded by its commercial bank members, although state-controlled. When spending is undertaken, the government instructs its bank, the central bank, to transfer funds from the government's coffers via commercial banks to account holders in the private sector. In the first instance, spending directly boosts the amount of money in the economy. That could be the end of the matter. The government could use its cash at the central bank to finance government spending, or alternatively have the central bank extend an overdraft in practice. The money created by government spending is deliberately mopped up when the government taxes its citizens or issues bonds into the market. The critical MMT point is this. Via its ownership, control of the central bank, there is no priori reason why the state needs to engineer a cash flow, taxes or borrowing, to undertake government spending. The fourth strand of MMT thinking follows from this. As Scott Fulwiler, Rowan Gray and Nathan Tankus, 3 MMT advocates, said in an article for the Financial Times on the 1st of March 2019, quote, "A monetarily sovereign country like the US, with debts denominated in its own currency and a floating exchange rate, cannot go broke. The only limit on government spending is inflation." Unquote. In short, a government always has the technical ability to repay its debts. Why? Because the central bank can always be instructed to create out of nothing the money required to meet any maturing obligation. The limit on government spending is purely a binding resource constraint, the inability of the state to increase spending without triggering rising inflation. These four pillars of modern monetary theory lead to a radically different policy framework, which grants fiscal policy a central role in managing the business cycle. Taxation is seen not as a means of raising revenue, but instead as a mechanism for withdrawing money from the economy when inflation beckons. So there is also no reason why debt needs to be issued to bridge any gap between outlays and receipts. Again, subject to this inflation constraint, the state can finance any budget deficit via the issuance of new central bank money. Price stability can still be the overarching aim of macroeconomic policy, but it is no longer the central bank's control over interest rates that keeps the economy on an even keel. A magic money tree? That is certainly the conclusion of most mainstream economists, even those who are supportive of activist fiscal policy. Larry Summers, the US economist, described MMT as, quote, a recipe for disaster, unquote, in a recent Washington Post article. I broadly share that conclusion, but this is not because the theory is wrong. MMT has identified important shortcomings in the conventional macroeconomic framework. It rightly stresses the need to rethink how we fight recessions and the collateral damage from premature fiscal contraction. It exposes a critical flaw in macroeconomic modelling, namely how banks and finance are treated. It also highlights a contradiction in the existing policy regime. On the one hand, financing of fiscal policy is irrelevant to macro outcomes and can be outsourced to a debt management agency that focuses solely on minimizing debt financing costs. But on the other, it is extremely dangerous for fiscal action to be financed by the creation of new central bank money, not debt issuance. The difference between explicit monetary financing and the implicit kind that takes place when a central bank is buying government debt under a quantitative easing program alongside a large fiscal deficit is a highly nuanced one. The balance sheet mechanics are almost identical. What separates them is the institutional framework in which they take place. Advocates of MMT have almost nothing to say on this point, but it is fundamental. The separation of powers between politicized fiscal authorities and operationally independent central banks is not an accident of history. 2 decades of damaging monetary instability after the breakdown of the Bretton Woods system led to today's institutional framework. It's not perfect and needs to be rebooted to manage the modern globalized financial system better, where financial instability seems the graver threat to the West's long-term economic health. But returning responsibility for price stability to politicians is going to end in tears. If this is not what MMT advocates want, they have been silent on what institutional setup will sustain an operationally independent central bank. If, instead, they want monetary financing to be an all-weather option, to be used at the behest of governments, this would appear incompatible with central bank independence. This would require a far-reaching regime shift, but MMT advocates have not spelled out the institutional setup required to make this framework operable. None of this would matter if MMT were to remain an iconoclastic viewpoint, hotly debated in the blogsphere, but without traction in policy-making circles. Yet we live in febrile times. Populism is on the march. In the United States, MMT has risen to prominence within the populist left insurgency that threatens the Democratic Party elite. More broadly, the existing policy regime may come under unbearable pressure in the next recession. Much is expected of central bankers, yet their monetary ammunition is largely depleted. The political dangers to independent central banks are all too obvious. At the same time, levels of public debt are high, sky high in some cases, yet even fiscally prudent political parties are flirting with a major fiscal expansion, for example the UK's Conservative Party. The failure of monetary policy will provide the rationale for fiscal pump priming and the political cover to unravel the institutional separation between the government and the central bank. The populist march towards overt fiscal monetary coordination has already started. Those who advocate such policies have no observable plan for how such coordination could be put into practice. It is essential that those who prize hard-won central bank independence think deeply about how explicit cooperation between the fiscal authorities and the central bank could be accomplished, while protecting those elements of the current regime that have proved so valuable. If not, the populists will draw up the new rules of the game. That will be the end of central bank independence and the era of low inflation that we have enjoyed for 3 decades. Unquote. End of article. In essence, the key takeaways from this article are: 1. MMT proponents argue that the state owns the bank that underpins the entire monetary system. 2. The state can finance any budget deficit via the issuance of new central bank money. And 3. Returning responsibility for price stability to politicians is going to end in tears. Now, of course, someone supporting a banking institution is likely to be biased, and to some degree, central banks have both an independent yet cosy relationship with governments. It is difficult to argue with Jamie, though, especially if one considers the arguments between President Trump and Jerome Powell, the chairman of the Fed Reserve. The latter wants to reduce rates slowly, and the former wants negative rates now. But Trump is not alone. There is little doubt in our view that central banks and world governments, to coin a phrase, are kicking the can down the road. The reason being is that when that can is eventually opened, the financial equivalent of a nuclear explosion will occur. Forget the nonsense that those who crave it argue, well, it will be less devastating if it's open now rather than later, because the end result is the same, whether you are now $22 trillion in debt or $50 trillion in debt. The figures are already too great to be repaid. This is why, to some extent, MMT has its attractions, as it delays yet again the day the can has to be opened. Ask yourself a very simple question. If you know that by pulling the pin on a hand grenade will blow you up as it's tied to your body, would you not delay pulling it for as long as you can? Eventually you will either die of natural causes or it will self-explode, but at least you may have had a longer life in the interim. Perhaps not a pleasant one with the ongoing threat, but one nevertheless. MMT may provide that lifetime, and some believe that it will. Or alternatively, it may actually cause the hyperinflation to occur more quickly. In either event, it's still a fascinating concept, and we are potentially entering into a new world of economics, even though it may be shorter-lived than the era we have already experienced. What do you think? Are you an MMT fan? If you are, do not be embarrassed to admit it. And do you think it is the preserve of the left in our politics today? Or could it potentially be particularly attractive to the right as well? Do share your views. We welcome them. We hope you have found this video interesting and informative, and if so, please give it a thumbs up and share it on social media. Please ensure that you have subscribed to our channel and press the bell sign so that you are notified of any future videos. Also, kindly visit our website at illuminatisilver.com, and if you haven't already done so, please subscribe either as a free or paying member for regular email updates and offers. Disclaimer. Illuminati Silver owners come from a background of banking, international wealth management and economics. Having now retired from these worlds, we are not qualified to give investment advice. Therefore, this and other productions must not be deemed to be giving such advice and merely represent the personal views of its owners. Glory, glory.
Amen.